Hey, good day, everyone. Welcome to our webinar. My name is Bert Salazar, and I am going to be your host today. I'm very excited to be here with you because we're going to be talking about something extremely important when it comes to your retirement distribution planning and your retirement assets. And that is, how do you have the ability to protect all of your retirement assets from any type of stock market volatility? So we're going to be spending good quality time on that. This is not going to be a very long webinar, but it is going to cover a lot of great information for all of you. So for those of you that are following us on Facebook Live, we're live on Facebook. So thanks very much for joining us today. And again, I'm going to be talking about, how do you get to protect your assets and yourself and your retirement income and distribution income during the bad times from a stock market perspective. So with that being said, let me take you right to the presentation. And I'm going to be sharing my screen with all of you so you can see the presentation. And then hopefully you'll get to see it now. And here it is. So let me just take you right to the very beginning of the presentation. All right, again, thanks very much for joining us. Bert Salazar, and I am going to be your host. For those of you that are just joining us now, and we're getting more and more people that are coming in. Now, obviously, it's been a long day. It's tax season. We do a lot of tax planning and tax preparation here at Gables. So it's been a pretty busy last couple of months, working 7 days a week. But at the end of the day, we can definitely see the light at the end of the tunnel because April 15th is right around the corner. So today I'm going to be discussing and taking a little bit of time to kind of walk you through, how to protect your retirement assets from stock market volatility. And this is something that is going to happen to all of us in retirement. And if you're not prepared, obviously you're going to pay the price dearly down the road. So obviously one of the first things I want to share with you is that Neil Bohr said a long time ago that prediction is very difficult, especially if it's about the future. And that, obviously it is a funny statement, but it is a very true statement because you can never predict an outcome from a financial standpoint. I know most people are doing preparation planning and so forth. So for that reason, one of the things that we try to do with each and every one of the clients that we engage is to help them protect themselves, their families, and their businesses, from the four major risks that they're going to be facing in the future. The risk of dying too soon and the impact that that would have on the surviving members of the family. The risk of living too long, where most of us are going to be spending a lot of time in. And obviously, what is the risks that are associated with living too long? Like, are you going to run out of money before you run out of life? Is your money going to be able to stand all of the different issues and concerns that we're going to be discussing today? The third risk has nothing to do with living too long, but it does have to do, with living with a disability. The fact that people are living a lot longer today, there's a much higher susceptibility to disability than ever before. The cost of long-term care, and we don't have time to talk about this today, but the cost of long-term care is increasing at 3 times the rate of inflation on an annual basis. So today, for instance, in Florida, if you happen to be in a nursing home, the cost is going to be somewhere around $92,000 a year. And Medicare does not cover long-term care, which is something that, many clients, when we engage about long-term care and disability and so forth, did not realize that Medicare does not cover long-term care. And then last but not least, which is the area that I'm going to focus on today, is the risk of living with eroding factors, taxation, inflation, stock market volatility, interest rate volatility, propensity to consume. So today, we're just going to be addressing, the eroding factor of stock market volatility, which is one of the major issues and concerns that all of us are going to have to deal with at some point in time in the future. So obviously, would you ever jump out of an airplane without a parachute? From a financial standpoint, a lot of the clients that I engage for the first time have done exactly that. They have actually jumped out of an airplane without a parachute. They have jumped into the abyss of retirement without having any type of proper protection for their retirement assets and their retirement income. As a matter of fact, if you were really trying to jump out of an airplane with a parachute, the next question is, well, on a scale of 1 through 10, do you want to have the worst parachute or the worst quality of a parachute out of 1, or do you want to have the best quality out of 10? I would argue that 100% of us, unless you're thinking about suicide, you're going to be choosing not only one parachute, you're going to be choosing multiple parachutes, and you want the best possible quality that money can buy. Now, by the same token, when it comes to stock market volatility, I think is very important and apropos that I kind of walk you through the difference between the average rates of returns and the actual rates of returns. And I was a registered principal for many, many years. And because I was a registered principal, I used to, have to address a lot of these issues with not only the advisors that reported to me in California and also in Florida, but obviously with many other clients that I had to engage. And there's a very major difference between what an average rate of return is and the actual rate of return. Let's go through a couple of examples that I think you will find very interesting. Number one, let's say that in the first year, your portfolio has a 50% loss. And in the second year, the portfolio has a 50% gain. So on the average, the 2-year average for this portfolio is 0. You had a 50% loss in the first year, and you had a 50% gain in the second year. So the average 2-year loss would be 0. As a matter of fact, that is the way that mutual fund companies are going to be reporting their gains from 1 year to the next. They're going to be using the averages. They're going to use a 2-year average. They're going to use a 5-year, the 10-year, the 15-year, the 20-year average, how many years that portfolio has been around. They're going to average out, the rates of returns. But if we now put actual numbers to this exercise that I just walked you through, I think you're going to see something that is totally different than that 0% average rate of return. So let's go ahead, let's say that we're investing $100,000. So you're investing $100,000 into this portfolio. And again, the first year you had a 50% loss. So therefore, your account value at the end of the first year is going to be $50,000. And then you're going to have a 50% gain. You will be surprised how many people would say to me, well, Bert, if I had a 50% loss in the first year and then I get a 50% gain, my account value would be back up to 100,000, and that's not the answer. When you had 100,000 and you lost 50%, your portfolio went down to 50,000. And then when you got a 50% gain, that 50% gain is on the 50,000 that remained. So that would bring you up to 75,000. So in reality, although your average rate of return from an averages perspective was 0, your actual losses for that 2-year average was a negative 25%, or a loss of $25,000 to that portfolio. Let's go ahead and check out another example just to give you something that may be a little bit more suitable. So let's say that in the first year you have a 20% gain, in the second year you have a 20% loss. Okay, so obviously the average again is going to be 0, but when you actually put the numbers behind it, you'll see that in the $100,000 in the first year went up to $120,000. But then that 20% loss in the second year brings the portfolio back down to $96,000. Therefore, your the average of your 2-year losses, actual losses to the portfolio, was a negative 4%. So be very careful when you're looking at the average returns on mutual fund portfolios, not to fall trap to the actual averages and start paying attention to the actual. So that's something that I thought would be very important to bring to the table today in order to discuss with you. Now, obviously, the longest, we have just experienced the longest bull market in history. It ended in 2018. So, for the first time in a long time, the stock market has a Dow lost 6% in 2018. I'm very happy to inform to all of you that none of my clients I had the principal protection program actually lost any money in 2018. So I'm very proud of that, the type of work that I do with the clients, and the fact that the clients, were coachable, they listened, and they wanted to make certain that for the vast majority of their retirement assets, they wanted to have principal protection. So even if you make 1 or 2% in 2018, you offset at losing 6% in the market. So you actually had a positive, 7 to 8% return when you look at it from that perspective. Now, bull markets have a tendency to actually crash as opposed to slide. Now, no one knows what's going to happen in 2019. Obviously, the market is doing fairly well right now, but, we're only in the first quarter, finishing the first quarter of 2019, and there's a lot of stuff that may happen between now and the end of the year, as it did in 2018, that caused for that market to drop nearly 6%. Now, are we closer to a crash than ever before? Yes, absolutely. Obviously, it's a game of numbers. And, if you notice, we went almost 9 years. We actually hit 9 years, 9.5 years of a bull market, which is the longest bull market in the history of the U.S. economy, but then obviously corrected itself a little bit in 2018. What is 2019, 2020, 2021 going to bring to the table? No one knows, but you have to be prepared for anything that may happen in the market. How long will the next crash last? The longest recovery took 25 years. Now, how many 25 years do you have in your retirement life? Probably one. And you don't want that to be recovering for a market loss, because the rules of engagement totally change when you go from accumulation to distribution, and we'll talk a little bit about that in the next few minutes. Another point here is, how many parachutes do you have on your retirement assets and investmts? Do you have one? Do you have two? Do you have none? And if you do have a parachute, what type of quality can you assign to it? Is it the right qualities that are going to protect you through all the market's ups and downs that you're going to be facing in the future throughout your retirement life? So again, these are things that are important to consider. Are your investments prepared for the double crash? And the double crash is nothing more and nothing less that when you're in retirement and there are years where the market is going to crash. Think of it this way: every 10 years, the market is going to drop anywhere between 2 to 4 years out of that 10-year period. But if you have to, on top of the market taking a drop in return, and you're losing money in the market, 10, 15, 20, 25, 30%, you also have to take distribution in order to maintain your standard of living. That is going to be compounding the negative effect of that negative return for that year. So that means that you may very well be experiencing a double crash that you had never forecast before. So, when you take a look at the market, no bull market has ever made it to its 10th birthday. And obviously, 2018, we came very close, but we did make it. So, no market has ever made it to 10 straight years of positive returns. By the way, for those of you that may not remember, because we humans have a tendency to forget a lot of the bad things that happened to us in the past, is that the second largest bull market in history was the dot-com market of the 1990s and the early 2000s. And obviously that one didn't end up very well. Almost 80% in losses after it was all said and done. So, is that going to happen again in the future? Absolutely. When is it going to happen? There's no way that I can tell you, because obviously if I could, I wouldn't be here today explaining it to many of you. So, from a risk management perspective, my job is to make certain, as I engage most of you moving forward, and for the many clients that I deal with on a regular basis, is how can I protect you from yourself, and how can I protect you from things and concerns and issues that you have very little control over. Obviously, behavioral scientists have said the same thing that I just mentioned. We do have a tendency as humans to kind of part ways and put things aside that really have a bad impact on us, and we kind of block it, and we have a tendency to forget about it. But when it comes to your retirement distribution planning, you don't have too many chances. You only have one chance to get it right, and if you don't get it right, then obviously you're gonna face some dire straits at some point in time in the future. Now, before I go any further, I think it's very important that I can share with you the different types of investment risks. But there are two in particular that I want to share with you. The first one is what we call the unsystematic risk, and that is the risk that is associated, with investing in a single company or in a single stock. We're going to be discussing a particular example with Citigroup in the next couple of minutes. But if you had invested in Enron, as you know what happened to Enron, a lot of things can happen. Employees go on strike, the CEO dies, product failures, scandals, fraud. Enron was one of the biggest frauds that we've had to deal with in American history. If you have all your eggs in that basket, and you think you're going to be able to make it to the promised land in retirement and have a very successful life, then the probability of that happening is going to be slim to none, because you would have lost all of your money at Enron when it first came. And the same thing with Citigroup, which I will cover in the next couple of slides. Now, obviously, the next risk that I want to share with you is not the unsystematic risk, which deals with one company, but it's a systematic risk. And the systematic risk, as you see there, is the risk that is inherent to the entire market. So the entire market collapses from something that may have happened along those lines. Now, if you remember 2008, the real estate market or the dot-com, where the entire market and all of its sectors collapsed at the same time. Obviously wars, 9/11, inflation, higher taxes, bubbles, which is what I just went through a couple of seconds ago, recessions, depressions, all of these things can have a negative impact. Like in 2008, 2009, even the bond market, which is usually measured to offset, the volatility in the stock market, the average bond portfolio lost anywhere between 25 and 35%. Can you imagine if you had been in retirement at that point in time, and as the market was heading south, you still needed to take money in order to make ends meet? How would that portfolio be doing today? Now, let's take a look at Citigroup, and this is back in 2007, and this is a definition of the unsystematic risk. If you take a look at Citigroup, in 2007, it was just going along, and then all of a sudden, by the end of 2009, Citigroup stock was almost worthless. Can you imagine if you had all of your eggs in that particular basket, and what that would have done to you, to your family, and to your retirement distribution planning at that point in time? Now, what is the solution for an unsystematic risk? Well, number one, you want to be able to invest in a broad range of companies in order to have diversification, and not only in a broad range of companies, but also in a broad range of sectors. So if you're able to do that, at least you're going to have the ability, to mitigate some of those stocks, individual stocks, that may have certain volatilities above and beyond the averages from that perspective. Now, the challenge, and this is what we call asset allocation. So you want to make certain that you diversify amongst many different companies and in many different sectors in order to minimize that volatility. But one of the challenges with asset allocation is that neither assures nor guarantees whatsoever either any better performance or that it can protect you from losses in a declining market. So all you're doing with asset allocation is trying to diversify your risk, but it's not guaranteeing that you're not going to be losing money if, in fact, there's something that is unsystematic and that it hits entire sectors or the entire market overall. So you have to be very careful. And here we have an example of that. Take a look at the same period from 2004 through 2009. And this included the vast majority of the sectors in the industry. So we're including here the Russell 2000, the Dow Jones Industrial Average, the S&P 500, the NASDAQ. So if you had a portfolio invested in all these sectors, you would have had at least 2,600 companies inside that entire portfolio. So from an asset allocation standpoint, you would have felt very comfortable because you figured that you were going to be totally diversified. Look what happened in 2008 and 2009 on that portfolio. The entire market went down. Now, if you were in retirement and you needed to continue to take money out, probably through today, you would have never been able to recover, because of the fact that now you were compounding the problem and you were creating that double crash that I talked about a little while ago, because of the fact that the market was heading south and you needed to sell your shares at the worst possible time in the economy in order to maintain your standard of living and that of your family as well. So managing all of these risks is very, very important and very critical from a business perspective. Now, the next question that I want to, or the next topic that I want to share with all of you is, well, how long will it take if you do suffer a loss and then you want to try to rebuild that portfolio? So let me give you an example. Let's say that you have a 40% loss. In order for that portfolio to break even, to get back to the point where it was before the market started heading south, you would have had to have in 1 year a 67% return. It's not like you drop 40% and then you pick up 40% and you're back to zero. This is the same exercise that I just covered a few minutes ago. So if you have a 40% loss in the market in a given year, it takes 67% return the following year in order to get back to zero or to get back to even. Now, what if in the market you had that 40% loss and then you're trying to recover in the market? Obviously, the market is not going to increase by 67% or 100%, so it may start to recover, in this case, let's say 8% per year. Well, it's going to take you 6.6 years, almost 7 years to recover from the market crash. And that would be if you're not taking any money, most of the time, because remember, those of us that were employed in 2008, 2009, the market had a tendency to recover a lot quicker. Why? Because if you were investing in a 401k and you were still working, while you were still making contributions to that 401k, you were more than likely getting a match at that point in time, so that helped with the recovery. And then because of the fact that you were still employed and you didn't need to access the assets at that time, then you did allow the portfolio to recover. When you enter retirement, the rules of engagement totally change, and it can have a damaging effect if you don't know how to protect your assets in retirement. So what is the solution to systematic risk? Well, number one is you want to have portfolio insurance. And portfolio insurance is nothing more than making certain that you find products and services that are going to give you the ability to transfer that liability from yourself to a company that can manage risk and that can guarantee you not losing your retirement assets from a business perspective. Now, remember that we have a tendency to insure everything that we own. We insure our cars, we insure our homes, we insure our lives with life insurance, we insure our ability to wake up in the morning and earn income through disability policies. So we do have the ability to insure everything that we own, but many a times we fail to insure our portfolio and our retirement income and our retirement assets. So obviously having portfolio insurance is going to be very critical for the vast majority of Americans, not only now, but for many, many years to come. And then obviously the second thing that you may want to have is you want to have, principal protection. And again, you have to be able to measure the financial impact of having guaranteed principal on your side of the ledger and also guaranteed income. If you're able to do that, then your life is going to be very, very successful in retirement. Because of the fact that I'm a tax planner and I do tax preparation and I'm a retirement strategist, the vast majority of the clients that I engage are either 5 to 10 years away from retirement, or they may be finding themselves in retirement as it is today. I have never had a client of mine in retirement that said to me, Bert, you know, I wish I didn't have that much guaranteed income. The vast majority of the clients that I engage in that are in retirement are always telling me that they wished they had more guaranteed income in retirement than they do today. So as part of the education that we provide to all of you, my number one goal is to make certain that I can educate you to the point that you can live a long life, that if you become disabled, that your assets are going to be protected, that your life is going to be protected, and most important, that you're not going to run out of money before you run out of life because of the fact that either you made some bad financial decisions in retirement, or you had the eroding factor of stock market volatility and interest rate volatility along those lines. So let's talk a little bit about market history, because I think it's very important for all of us to have a clear understanding, because again, we do have the tendency to forget. So something happened with the Dow Jones in 1999. And had never happened in the history of our country. The Dow Jones, for the first time in history, in 1999, hit 10,000 points. Fast forward 7 years later, in 2007, the Dow Jones again did something that it had never done in history, which was hit 14,700. By sometime in March of 2009, the Dow Jones went from 14,700 back down to 6,700. It was one of the major and the biggest drops in American history for the Dow Jones Industrial Average. And then between March of 2009 and December of 2009, the market kind of crawled back up again, and it got back to 10,000 once again. So the point here is that it hit 10,000 in 1999. And then the next time that it hit 10,000 again was in December of 2009, although in 2007, it went up to 14,700 points. So this is what we call the decade of nothing. So if you were in retirement at that point in time and you needed to take money out of your portfolio and you were going through this market volatility, chances are you were going to run out of money before you ran out of life. You know, obviously I didn't have any clients that experienced that, but I did have clients that came to engage me for the first time after 2009, and they had experienced some of those losses tragically in the past couple of years at that point in time. Now let's take a look at the NASDAQ. Again, the NASDAQ in March of 2000 hit 5,000 points for the first time in history. Do you have any ideas? You want to take a guess as to when was the next time that the NASDAQ hit 5,000 points again? As a matter of fact, it wasn't too long ago. It was almost to the day in 2015. So the NASDAQ went on a 15-year hiatus from 2000 to 2015. By the way, when you're in retirement, how many decades or decades and a half do you have, can you afford to have of market losses and hiatuses before you run out of money, before you run out of life? For most of us, we can't even afford one of them. So this is why it's so important to pay attention to the Principal Protection Program and the things that you can do in order to avoid that market volatility and protect all of your assets or most of your assets in retirement from a business perspective. So what will cause the next crash? Well, your guess would be as good as mine. Could be, you know, interest rates, you know, obviously that can have an impact on the economy. Cyber attacks and disruption to power grids, that's something that we're starting to see, you know, from time to time. World leaders, you know, with their fingers on the trigger, and this is something that we have no control over. Emerging markets in distress or chaos, and we've seen that already in Europe and in the Middle East as well, from that perspective. China trade war, we're actually dealing with China today. There may be some internal cracks that we need to deal with at some point in time in the next few years. Trump may be impeached. That's something that everyone is talking about. Whether that's going to happen or not, who knows? But that could be a susceptibility. That's something that could happen in the future. New tax laws and ease of government regulations may be terminated by the Democrats if they happen to take power. And what impact is that going to have on the economy overall? And obviously taxes may have a negative impact on that as well. And then tight labor markets can also have a negative impact in the U.S. economy and the United States from that perspective. So obviously these are things that we got to be paying attention to. Now, when it comes to the distribution phase, is something that the vast majority of the clients that I engage for the first time have never really experienced. Because what people fail to realize, and Americans fail to realize, is that while you're in the accumulation stage, when you're putting money away for retirement, you're still employed, you're putting money away, you're making investments, you're putting money away. So the accumulation stage is totally different than the distribution stage. When you get to the top of the mountain, now you're in retirement, the distribution stage coming down the mountain is going to be very critical. I like to use the mountain analogy because it's very important for all of us. If you're climbing a mountain, the first thing that I ask a lot of my clients, well, if you were climbing a mountain, what is the goal? And they all say the same thing, well, to get to the top of the mountain. And the goal is not just to get to the top of the mountain. The goal is to get to the top of the mountain and to make it back down safely all the way back down to the very bottom. Well, retirement is the same way. As you're climbing the mountain, you're in the accumulation stages. But once you get to the summit and you get to the top of the mountain and you're going to start coming down on the other side, that would be considered a distribution stage. So what are some of the things that are going to be impacting coming down the mountain, coming down the financial mountain from a business standpoint? Well, number one, the sequencing of returns. See, the sequencing of returns, the averages and what the market did one year versus the other, may not have as much of a negative impact during your accumulation years than they do during the distribution years. And again, we have already talked about the fact that you don't need the money, you're employed, you're still putting money into those 401ks and IRAs and other retirement and investment vehicles. So you're not too concerned about that. Up until that point, all you have are paper losses. When you get into the distribution stage, now you move from a paper loss to an actual loss. Product allocation, where's your money invested? That also going to have a major impact on whatever it is that you're doing. And then obviously, what percentage of your retirement assets do you have principal protection assigned to it? So I'm going to give you an example, and you're going to find that this example is very simple. We're going to have two families and two portfolios. So we're going to have portfolio A. And by the way, if you notice at the bottom of the portfolio, the rates of returns are the same. You have an average rate of return of 8%. The only thing that I have changed in these two portfolios is that in portfolio A, I put the 3 years of actual losses at the very beginning of the portfolio, where in portfolio B, I put those 3 years of losses at the very end of the portfolio. If you look at that, take a look at what happened. Portfolio A, by the time the client reaches the age of 82, they actually ran out of money. Houston, we have a problem. These clients have actually run out of money before they run out of life. And the reason for that is that, see, you can never tell, and you can never kind of emulate or simulate, what the market is going to be doing the first few years in retirement. So if you would have retired in 2018, obviously you already had the first year of losses. What if 2019 and 2020 brings another 2 more years of losses and you happen to be in retirement at this point in time? Then your portfolio is going to be totally different than you have if you have gains during your early years in retirement versus your later years in retirement. In portfolio B, if you notice, the client was taking 5%, same as in portfolio A, and the client at age 90 still had over $2.6 million of assets in the portfolio, and still had plenty of money left. So understanding the sequencing of returns is very apropos from a business perspective. So what you want to try to do is you want to make certain that your assets are protected on the down years as opposed to leaving them totally naked from that perspective. So now, obviously, I'm sure most of you remember some of these companies. Some of these companies no longer exist. I know Merrill Lynch obviously still around, but he was bought out by B of A because otherwise they would have gone bankrupt. But these are the 2008 failures that we experienced at that point in time. Now, let me discuss a little bit the Principal Protection Program, because I have given you a lot of the issues and concerns that I can see from a market perspective, and the importance of having your principal protected during your retirement years, and what a true and a well-structured principal protection program can do to yourself, your family, and your business. The one question I always ask my clients is, what's better? You know, a hammer or a screwdriver? And the answer is always, it depends. Well, the same thing happens with the Principal Protection Program. There are many different products and many different companies that are providing these services to Americans that are getting closer and closer to retirement. And it's just like going to Baskin-Robbins and trying to buy ice cream. As you can see there in the Baskin-Robbins logo, there are 31 flavors of ice cream at Baskin-Robbins, and there are many different flavors in the type of Principal Protection Program that you may want to put a certain percentage of your assets in retirement. So for instance, the big question is, well, you know, how would you like to have your cake and eat it too? And if you have the right Principal Protection Program, and for many of the clients that we engage in, by the way, this may not be suitable for each and every one of you. Some of you may benefit from this. I would argue that the vast majority of you are going to benefit from a well-structured Principal Protection Program, but we have to look at it individually because every person is different. It depends on you're willing to take risk. It depends on the amount of assets that you're going to have. It depends on the liquidity that you may want to maintain in your portfolio that will determine, you know, which flavor of Principal Protection ice cream we're going to be using for your individual situation. But if you have it structured the right way, then you can get the best of all worlds. Number one, you're going to have growth potential. So as the market grows, you're going to be able to grow with it. You're also going to have principal protection. So you're going to be able to participate in the upside potential of the market, but you're not going to have to participate in the downside protection potential of the market, because of the fact that these vehicles are designed to guarantee the principal without having to risk the principal at all. So it's something that is very, very interesting for the vast majority of clients that I engage for the first time. The vast majority of these programs either have no fees or they have very little fees assigned to them, which, and I'll share that with you in the next few minutes. And obviously some of these contracts even provide for long-term care benefits. So if you have money invested in a principal protection program with a company that offers a long-term care rider, then now you have the best of both worlds. Because if you have a need for long-term care, many of these contracts will allow you to double the distribution rate out of the contract in order to mitigate the additional expenses that come with managing long-term care in retirement. And then obviously you have all sorts of income benefits, including guaranteed income for life. So think of it this way. Let's say that you go to Vegas, and I don't know if any of you have ever played blackjack, but I've done that several times when I go to Vegas, you know, with my family. But when you get to Vegas for the first time and you sit at the blackjack table, you know that in blackjack you can either win, push, or you can lose. But what if the blackjack dealer at that table said to all of us listening to this webinar tonight, well, guys, I'm going to be changing the rules of engagement. Instead of you having the ability to lose at this table, you're only going to have two choices. Either you can win or you can push. Now, how many of us are going to be at that table, and how long are going to be there? I can assure you, I'm going I'm going to be sitting at that table for the rest of my life, because if the worst that I can do is push, then I'm going to be playing at that table for as many years as I possibly can. And obviously, that's the same thing that these companies would want you to do when you put money into these programs. Now, the next question that I want to address is, well, once you get into a principal protection program, how are fees applied to these types of programs? Well, let's take a look at traditional mutual fund fees. If you look at traditional mutual fund fees, you will notice that the fees will range between 1% and 2%. Sometimes could be a little bit higher than that, but just for average sake, between 1% and 2%. Now, the fees are charged every single year, and this is in traditional mutual fund investments, like in your IRAs and your 401ks and your investment accounts that you may have with, a brokerage firm or whatever that may be. So they're going to be charging those fees every single year, whether they're gains or losses in your portfolio. Most important, the fees are going to be charged on the entire account value. Now, when it comes to the fixed index annuities or the principal protection program fees that I've been discussing with you now, the fees can range anywhere between 1.5% and 2.5% on fixed index annuity contracts. And the reason why they charge those fees is because they have to be able to manage the risk. Because remember, they're assuming all the liability for the losses. So they need to do actuarial calculations. They need to buy, puts on the market. And that's something that the vast majority of Americans have no idea of how to do. And I wouldn't recommend any of us, not even myself, which at one point in time I had the Series 4, I would not want to entertain trying to do that. But these companies specialize in doing that, and they do it very well, to the point that they will actually guarantee your principal because they are so good at what they do. Now, the other thing that is different between a fixed index annuity principal protection program portfolio and traditional mutual funds or 401ks and IRAs is that the fees are only charged on the years that there is a gain in the portfolio. Because remember, if there's a loss in the portfolio, you cannot lose, so that is guaranteed to you. And is only charged on the gains. And that's a big, big difference compared to anything that you may have heard of in the past. So the fees will only be on the gains, and it will only be in the years that there's a gain in the portfolio. So it's a big difference between having to pay fees on a $200,000, $300,000, $500,000 portfolio on each and every dollar, as opposed to only having to pay the fees on the incremental growth from one year to the next, if there's a positive return in the market. So those are things that are very, very important to all of us. Investment options, obviously, just like you can invest in indexes. And obviously, you have the ability to diversify as well. By the way, if you know that you cannot lose your principal, wouldn't you want to invest as aggressively as you possibly can in order to maximize the internal rate of return on the portfolio on the plus years as opposed to the negative years from that perspective? So obviously, that's important to note. Questions that many of my clients would have and many of you would have on this call: can I lose money? And the answer is no. Whether it's an immediate fixed or an index annuities, the insurance company that offers these programs, they assume all the liability. Now, obviously, it is based on their claims paying ability, but these carriers, they're all A+ rated carriers. Otherwise, we would not do any business with them. And many of them have been around for at least 100 years from that perspective. Will my cash flow fluctuate? And the answer is no. Income can only go up. And as a matter of fact, any time that the market does well, your income will actually go up as well. But in the years where the market loses money, your income will stay at the level that it was from the previous year. So that gives you a lot of inflation hedging on your income as well from that perspective. Can these annuities generate income for life? Absolutely. There are many different ways to create income for life. You can annuitize, and in some of these fixed index annuity contracts, you don't even have to annuitize the contract, and you will continue to receive income for life, even if you have lived such a long life that now there's no more money in the portfolio because you've lived a very, very long life, while the insurance company has a guarantee and has a contractual guarantee to continue to provide that income to you for the rest of your life, like if you had a pension or your Social Security benefits, similar to that exercise as well. Another question is, if you do proper laddering and hedging, you may actually be able to increase your distribution rate by up to 40%, depending on the portfolio, depending on what you're doing with other assets that you may have from a business perspective. So, those are things that are very, very important because, for the vast majority of the clients that I engage for the first time, having principal guaranteed, having guaranteed income for life, because remember, as I've stated before, the rules of engagement totally change when you go from accumulation to distribution. So it's important for you to be able to do a couple of things. Number one, my call to action to all of you today is, stop doing the definition of insanity. As you all know, the definition of insanity is doing the same thing over and over again and expecting a different result. Make sure that you review your portfolio. Make sure that, you do have the ability to create a customized tax planning blueprint that you can reach out to me and my firm, and we will do for you at no cost or obligation. So feel free to engage us. If you want more information, if you have other concerns or other questions regarding what we've talked about tonight, please feel free to reach out, and I'll be more than happy to cover those things with you at any point in time in the very near future. If you feel like it, you may want to schedule a 30-minute video conference or conference call with me. Many of my clients engage me on a video call, which is, having the ability to see each other while we're having a discussion regarding your issues and concerns. If you want to reach out to me for any questions, feel free to call me at, area code 786-766-1042. You can also send me an email at, bert.salazar@cambridgefpllc.com, which is one of the companies that deals with the annuities and the fixed index annuity side of the house. Or you can send me an email to my tax planning firm, which is Gables Tax Planning Group. And therefore, you can email me at bert@gablestaxgroup.com, and I'll be more than happy to schedule a call with you from a business perspective. I think at the end of the day, to finalize this short webinar, is the idea for all of us. You want to make certain that throughout your retirement life, that whatever may happen to you in the future while you're in retirement, that you will always have a safe landing for all of your retirement assets. One of the questions that I get asked all the time, Bert, what percentage of my portfolio should go into a principal protection program? And my answer is it depends, but most of the time the rule of thumb is, take your age from 100, and that would be the amount of money that should go into your principal protection program. So, if you're 50 years of age, 50% of your money should be there. If it's 60 years of age, 60%. The older you get, the more money you should have in guaranteed accounts in which your principal and your income is fully protected. And as I always say at the very end of every webcast that I do, every webinar, every podcast that we do on a weekly basis, my number one goal and that of my firm is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time today, and I look forward to talking to you again very, very soon. Take care. Bye-bye.